Most people approach financial success the wrong way. They ask, how do I get rich? That's the wrong question. The right question is, how do I avoid staying poor? Invert, always invert. This comes from the great mathematician Carl Jacobi. Many problems can't be solved forward, so you must think in reverse. And here's what I've learned: avoiding stupidity is easier than seeking brilliance. Avoiding stupidity was my definition of intelligence. In investing and in personal finance, that means avoiding leverage, envy, overconfidence, and impatience. It means avoiding the 7 catastrophic mistakes I've watched smart people make repeatedly over 70 years. First mistake: buying things that depreciate. A new car loses 20% of its value the moment you drive it off the lot. You're not making a smart purchase, you're setting fire to money. Wealthy people understand this math. They buy what doesn't lose value, or better yet, what gains value over time. Second mistake: confusing high income with wealth building. I've watched doctors earning $300,000 save less than project managers earning $60,000. Why? Because the doctor spends $295,000 maintaining a lifestyle that impresses people he doesn't even like. High income means nothing if consumption matches or exceeds it. Wealth is not what you earn, it's what you keep and invest. Third mistake: investing in things you don't understand. This is fundamental. The worst thing you can do is invest in companies you know nothing about. We have 3 baskets for investing: yes, no, and too tough to understand. If you can't explain an investment to a 12-year-old, you don't understand it well enough to own it. And we have a passion for keeping things simple. If something is too hard, we move on to something else. What could be simpler than that? Fourth mistake: paying high fees for basic services. Let me tell you something about the investment management industry. If I had to name one factor that dominates human bad decisions, it would be denial. Take investment management. How many managers are going to beat the indexes? All costs considered, I would say maybe 5%. Everybody else is living in a state of extreme denial. They're used to charging big fees for stuff that isn't doing their clients any good. It's a deep moral depravity. A 1% annual fee doesn't sound like much, but over 30 years, that 1% will cost you hundreds of thousands of dollars in compound returns. I can't think of a single example in my whole life where keeping it simple has worked against us. We made mistakes, but they weren't because we kept it simple. Use low-cost index funds, minimize fees ruthlessly. This is not complicated. Fifth mistake: making financial decisions based on emotion instead of math. A lot of people with high IQs are terrible investors because they've got terrible temperaments. They buy when euphoric, sell when terrified, chase performance, avoid what feels scary, but has superior long-term track records. Here's what I've always said: if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder, and you deserve the mediocre result you're going to get. Sixth mistake: optimizing for tax deductions instead of actual wealth. People buy bigger houses than they need because mortgage interest is tax deductible. But a tax deduction saves you perhaps 25 cents for every dollar spent. You're still spending 75 cents. That's not wealth building. That's self-deception dressed up as financial sophistication. Seventh mistake: treating your primary residence as an investment. Your house is shelter, not an investment. It generates no income. It costs money monthly in taxes, insurance, maintenance. The appreciation is often less than inflation when you account for total ownership cost. Buy a modest house relative to your income and invest the difference in productive assets that actually generate returns. These 7 mistakes share a common pattern. They all feel reasonable in the moment. They all involve trusting conventional wisdom. They all seem like small decisions, but compounded over decades, they create the difference between wealth and poverty. Every single one of these mistakes can be avoided by simply asking, am I being stupid right now? If you can eliminate stupidity from your financial life, if you can avoid these 7 mistakes consistently, wealth building becomes not just probable, but inevitable. The formula is simple. By appreciating assets, not depreciating ones. Save aggressive percentages regardless of income. Invest only in what you understand completely. Minimize fees with religious fervor. Make decisions from math, not emotion. Optimize for wealth, not tax deductions. Treat your house as shelter, not speculation. Follow these principles and you won't need luck. You'll just need patience and the discipline to avoid the stupidity that destroys everyone else.
Most financial advice is backward. It tells you what to do, but stops short of telling you the habits that kill wealth. Today, we fix that. I have spent decades watching how the rich actually behave and how people who think they are smart still go broke. They do not lose money because they are unlucky. They lose money because they buy the wrong things, follow the wrong habits, and trust the wrong advice. In this video, I am going to reveal the 7 money mistakes even smart, hardworking people make, the ones that quietly destroy wealth. Not theory, not guesswork. Real patterns I have seen over decades in the trenches. If you want to change your financial life permanently, you must stop these habits today. Welcome to Harper Mumbling. The patterns we are discussing today are not theoretical. They come from observing 2 groups of people over extended periods. The first group consists of individuals who built significant wealth, net worth exceeding $1 million, starting from modest or zero initial resources. The second group consists of intelligent, educated people who earned good incomes but never accumulated substantial wealth despite decades of working. The difference between these groups is not intelligence or income level. It is behavior, specifically 7 behaviors that wealthy people systematically avoid while broke people repeatedly engage in them. The first mistake that kills wealth is buying depreciating assets while thinking you are making smart purchases. A depreciating asset is anything that loses value over time and generates no income. Cars are the most common example. In 2024, the average new car costs $48,000. The moment you drive it off the lot, it is worth $43,000. After 5 years, it is worth perhaps $22,000. You have consumed $26,000 of value through depreciation alone, not counting insurance, maintenance, gas, and interest if financed. Wealthy people understand this math and behave accordingly. They buy reliable used vehicles that have already absorbed the steepest depreciation, or they buy new only when the vehicle is a legitimate business expense that generates income exceeding its cost. A specific example demonstrates the wealth impact of this single decision. 2 people, both earning $65,000 annually, make different choices at age 25. Person A buys a new car for $40,000, financing $35,000 at 6% over 5 years. Monthly payment $676. Person B buys a 5-year-old version of the same model for $18,000, paying cash from savings. Person A's total cost over 5 years, $40,560 in payments plus $3,000 in higher insurance, totaling $43,560. Person B's total cost $18,000 purchase plus $1,500 in lower insurance, totaling $19,500. The difference is $24,060. But here is where the wealth building divergence becomes dramatic. Person B invests the $676 monthly that person A spends on car payments. Over those same 5 years at 8% average return, that becomes $49,300. After 5 years, person A owns a car worth approximately $22,000 and has spent $43,560, net cost $21,560. Person B owns a car worth approximately $10,000 and has spent $19,500 but has $49,300 in investments. The wealth gap from this single decision over 5 years is $59,360. Multiply this pattern across a lifetime of consumer purchases, and the result is a difference between millionaire and broke. The second mistake is confusing high income with wealth building, which leads to lifestyle inflation that prevents accumulation. I have watched people earn $200,000 annually and build less wealth than people earning $60,000 because they spend $195,000 of the $200,000. High income is meaningless if consumption matches or exceeds it. Wealth is not what you earn, it is what you keep and invest. Millionaires understand that income is a tool for building assets, not a justification for lifestyle upgrades. A doctor earning $280,000 annually comes to mind as a perfect example. After taxes, this doctor takes home approximately $180,000. The lifestyle includes a $750,000 house with $4,200 monthly mortgage, 2 leased luxury vehicles at $1,400 monthly combined, private school tuition at $3,000 monthly, and discretionary spending on travel, dining, and entertainment, totaling another $4,500 monthly. Total monthly spending $13,100 or $157,200 annually. Savings rate $22,800 per year, roughly 12.7% of gross income. This sounds reasonable until you compare it to someone earning $65,000. A project manager earning $65,000 takes home $52,000 after taxes. This person lives in a modest apartment for $1,200 monthly, drives a paid-off used car, has no debt, and lives on $2,800 monthly total. Total annual spending $33,600, savings $18,400 annually, roughly 28.3% of gross income. Over 20 years, the doctor saves $456,000 while spending $3.14 million on lifestyle. The project manager saves $368,000 while spending $672,000. When you account for investment returns at 8% average, the doctor accumulates approximately $1.04 million while the project manager accumulates $841,000. The doctor earned $5.6 million total over 20 years. The project manager earned $1.3 million, yet the wealth gap is only $200,000 because the doctor spent nearly every dollar earned while the project manager invested aggressively despite lower income. The third mistake is investing in complex financial products you do not understand because someone persuasive recommends them. Millionaires invest in simple, boring assets they completely understand. Broke people invest in complicated products with hidden fees and poor track records because a salesperson convinced them it was smart. I have watched intelligent people lose tens of thousands in variable annuities, actively managed funds with 2% expense ratios, structured notes tied to exotic indices, and cryptocurrency projects they could not explain if their life depended on it. The pattern is consistent. The investment comes with a compelling story, usually involving some combination of beating the market, tax advantages, or insider access. The person making the recommendation earns a commission. The actual returns after all fees and taxes underperform simple index funds. But the investor does not realize this for years because the statements are complex and the losses are obscured by financial jargon. If you cannot explain an investment in simple terms to a 12-year-old, you do not understand it well enough to invest in it. Millionaires follow this rule religiously. They invest in businesses they understand, index funds tracking markets they understand, or real estate in areas they understand. Anything else is speculation, not investment. The fourth mistake is accepting high fees for basic financial services that could be obtained cheaply or free. A 1% annual fee on a $100,000 portfolio costs $1,000 annually. Over 30 years with 7% market returns, that 1% fee reduces your final balance by approximately $80,000. You pay $30,000 in fees and lose another $50,000 in compound returns. Those fees would have generated. Millionaires are ruthless about minimizing fees. They use low-cost index funds with expense ratios of 0.03 to 0.1% instead of actively managed funds charging 1 to 2%. They avoid financial advisors charging percentage of assets fees for basic portfolio management that software can do for free. An example clarifies the wealth impact. Two investors both start with $100,000 at age 35. Both invest $1,000 monthly for 30 years. Both experience 7% average market returns before fees. Investor A uses actively managed funds charging 1.2% annually and pays a financial advisor 1% of assets. Total fees 2.2% annually. Investor B uses index funds charging 0.05% and manages their own simple portfolio. At age 65, Investor A has approximately $980,000. Investor B has approximately $1,480,000. The fee difference created a $500,000 wealth gap. Both investors had identical income, identical contributions, identical market returns. The only difference was fees, and that difference compounded into $500,000. The fifth mistake is making financial decisions based on emotion instead of math. Buying when euphoric, selling when terrified, chasing performance, avoiding investments that feel scary but have superior long-term track records. Millionaires make unemotional decisions based on expected value, risk-adjusted returns, and historical data. They invest during crashes when it feels wrong. They hold through volatility when it feels terrifying. They ignore noise and follow predetermined plans created when they were rational. The sixth mistake is optimizing for tax deductions instead of actual wealth, buying a bigger house than needed because mortgage interest is tax deductible, spending money on business expenses that are technically deductible but do not generate corresponding income. Millionaires understand that a tax deduction saves you your marginal tax rate on the expense, but you still spent the money. Saving 25 cents in taxes by spending $1 is not wealth building. Only spend money that generates more than it costs regardless of tax treatment. The seventh mistake is treating your primary residence as an investment. Your house is shelter, not an investment. It generates no income. It costs money monthly in taxes, insurance, and maintenance. The appreciation is often less than inflation when you account for total cost of ownership. Millionaires buy modest houses relative to their income and invest the difference in actual productive assets. Broke people buy maximum house they can afford, trap themselves with huge payments, and have nothing left to invest in assets that actually generate returns. These 7 mistakes share a common pattern. They all feel reasonable in the moment. They all involve trusting conventional wisdom. They all seem like small decisions with minor consequences. But compounded over decades, they create the difference between wealth and poverty. Stop these mistakes today. Buy appreciating assets. Save aggressive percentages regardless of income. Invest only in what you understand. Minimize fees ruthlessly. Make decisions from math, not emotion. Optimize for wealth, not tax deductions. Treat your house as shelter, not investment. Follow these principles and wealth building becomes inevitable regardless of your starting income. This is Harper mumbling, and if this breakdown of the 7 wealth-killing mistakes showed you patterns you are currently following and need to stop, please like this video, subscribe to the channel, and share it with anyone making these mistakes while wondering why they cannot build wealth despite good income. Leave a comment about which of these 7 mistakes you recognize in your own behavior. Turn on notifications for future videos about behavioral patterns that separate wealth builders from wealth destroyers. Thank you for watching, and remember, intelligent people go broke not because they lack information, but because they follow behaviors that feel smart but compound into poverty. And the only solution is recognizing these patterns and stopping them immediately before another decade passes with the same results.